You're listening to The Wealth Advocates with finance experts John Mickelson and Patrick Jenkins. The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Welcome everyone. We're grateful to have you tuning in with us today, and we're excited to share this quarter's topic, which is the state of the markets. And we have with us Brad Harsch and Patrick Jenkins, myself, John Mickelson. We're excited to kind of discuss the events that have happened, where we are, and where we're heading. So I get to kick things off with kind of where we are, or where we came from last year. And, you know, one of the interesting things in terms of the history of the last year or so, to me, it's this debate between the pandemic and stimulus.
Yeah.
And that seemed to override the entire, everything that we looked at from last year and then kind of heading into this year. That said, you know, part of our job and part of what we try to do is to try to say, you know, we're your financial project manager, so we need to be looking at the overlay of the economy as the discussion for today, but that has impacts on estate planning, it has impacts on your taxes. I mean, the landscape is changing due to what's occurring today and what happened the last year or so. So the other thing I would point out is with the amount of growth that we'll discuss, boy, there's a lot of exuberance, a lot of speculation, a lot of discussion around what's hot and what's not. Mm-hmm. And I want to emphasize that our approach to what we're doing is to take luck and guesswork out of it and rely more on, you know, statistics, data, and probability.
You know, that's the whole concept behind the coordinated estate. That's the value proposition of Wealth Advocates, making sure that your investment plan matches your tax plan, which should match your estate plan, your legal documents, your risk plan, and your income plan. So taking a very systematic approach to wealth management, I think, is exactly what you're trying to articulate here. It doesn't exist just in the big picture, but also in the microcosm of the investment world. And that's what we'll focus on today.
Yeah.
And the fact is, just like our conversation today, there's going to be plenty of points that we're going to butt heads on and disagree with and have to figure out as a team.
Well, I think that's really the point is there are things that we know for sure and there are the things that we don't know for sure.
Yeah.
Mm-hmm. And so, you know, part of this is really relying on logic and data and really quantifying the probabilities, because that helps us kind of identify, because we will never be wrong 100% of the time, and when we never be right 100% of the time. We want to outweigh on the right side, and that will always lead us to a pretty good result. So,
well, I know I'm on the investment side looking at things, so I'm curious, what do you see as the backdrop for the markets? What do you see as...
Well, we look at the last, and that'll lead us into this next point, is there's four things. How did they perform? What did they, where are they now? What drove performance? How do financial experts forecast coming in? Now, I want to start with the forecast, because I think this is interesting. The forecast that we saw from J.P. Morgan, Morgan Stanley, Credit Suisse, all of them were coming in from 2020 to 2021. And remember, 2020 was just horrifically difficult. 2021, stimulus had happened. There was kind of a mild optimism that things would rebound a little bit. But if you notice the chart here, none of them were even close. I mean, the most optimistic was J.P. Morgan. They predicted 20% growth, and the actual was almost 27%. So, I mean, all of them were wrong.
Yeah, and certainly they're not idiots, because there wasn't really a lot of reason why 2020 to 2021 should be a fantastic year.
Yeah.
In that fourth quarter, and you're probably going to hit that, the first quarter of 2020, the market drops 23% in 30 days. And we all thought the sky was falling. People stay home, don't go out. And so that's your backdrop for these guys and their analysis on what 2021 was supposed to be looking like.
Yeah. And it really, and when you're in the heat of the moment, it's hard to see, hey, business is shut down, everything is going who knows where.
Right.
I mean, how do you optimistically say, hey, things are going to grow and this is going to be a phenomenal year?
Yeah, you take that Goldman Sachs number, which was so far and above what it was in 2020.
Yeah.
That's optimism almost to the point of stupidity in our mind. And yet the net result is what?
Is when there's chaos, it's when you should be looking for opportunity. So I mean, that's the fundamental backdrop of this whole thing is it was so bad in 2020, 2021 had huge probabilities in being a good year. Now, to their point, I don't know that I would have disagreed with any of them. I didn't think it would be that good either.
No.
No one did.
But their best case estimate, the group average was 4117 in the S&P 500.
Yeah.
They underguessed, and that's all these are guesses, right?
Yeah.
They underguessed by 20%.
Yeah.
And the market did 20% better than what they thought, even in their best scenario. So that's important to when I get to the part and start talking about what 2022 looks like.
Yeah. Now I have to share one quote, and this is one of my favorite Warren Buffett quotes. We've long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie Munger and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place away from children and also away from grown-ups who behave in the market like children. So I just think that's a very funny quote. But the point being, the reality is what we started with, and that is there are things we don't know and what we do. But we did see there's a lot of probability in growth in that period of time. And in any chaotic environment, that's when you should be looking for the opportunities.
And that's the thing with forecasts too. They represent just a starting point. It's a jumping off point for a conversation.
Yeah.
It is once we have a forecast, and then that gives us some sort of baseline as far as what the investing world and the economic community around us thinks could be the landscape for the coming year ahead. That gives us some tangibles to start to work off.
Yeah. So as you look at that, I mean, look at the chart. When we look at the performance and the behavior of the S&P 500 during 2021, and you see this first quarter, and there was a lot of choppiness in the first quarter, kind of up and down, and it did create, nobody knew really where it was going to go, even though it was gradually rising. And then you have this breakout period, and a lot of it really was, the early part was, the Delta variant becomes introduced. We're starting to see a little bit of the effect of all of the money being flooded into the market. And everybody's aware. Everyone knows the fundamentals of economics is when you put a ton of money in the system, it's very likely going to create inflation. And so we start to see a little bit of that. And the Fed, in turn, mid-year starts talking about, okay, we got to start looking at tapering, meaning raising interest rates. And really, you can't have one without the other. You can't have interest rates rise without a reaction on interest rates. So we see that, and you see, initially you see a lot of frustration and concern about raising interest rates because everybody wants cheap money. I mean, who doesn't? But what happens in most historical events is raising interest rates leads to a drop. People, get upset and fearful, and the market drops slightly. But in time, an inflationary environment favors two things, two major areas, and that's real estate and equities. So that is kind of an important thing, especially as we lead into what we're going to talk about going forward.
Mm-hmm. And at the center of it all, the Fed's real job is to control monetary supply.
Yeah.
And that affects both of those two areas you brought up.
And that monetary supply is what concerns me the most. I mean, you have so much money floating in the system. And you see it, whether you see it as a nation or globally, even here locally. I mean, of the last 10 clients that have come in, or 20 clients have come in, about 95% of them, if I ask them, is your cash too high, too low, or about right? Almost everyone is saying too high.
Yeah, that's the unique thing about this economy is everybody has cash in their pocket right now as a backdrop from the stimulus spending that's come in.
Well, the other thing that goes with that is, the Fed is saying, hey, get money out of the system so people will invest and save and buy consumer goods, which they have, but not as fast as they thought.
Yeah.
People are hoarding cash because of fear and doubt, which is a natural instinct.
Well,
So-
we'll talk about that in a little bit.
Mike's going to throw on the screen these inflection points of the market and what's happened during 2021. John, is there anything that occurred in 2021 that we can read into 2022? Are there patterns emerging? Are there things that we'll see again?
Well, and I'll transition to what you guys are going to, especially what Brad's going to talk about. But to me, what was effective and useful in terms of real growth, like when we saw the chaos of 2020, and we said, I call clients and say, hey, this is an opportunity. Mm-hmm. the major areas of investment were in mostly growth companies and technology. Well, where we are now, I don't know. I look at where we are now, and we're going to see inflation and stimulus spending in infrastructure. That's probably going to fuel a very different set of companies.
Could be.
So this idea of set it and forget it is probably not a very wise approach to money management right now. You need to be able to be adaptable and be able to see where the trends are going, and be able to adjust and change, and not get outside of your risk tolerance. You know, if you're a moderate, don't go overboard and get into aggressive or too conservative. You've got to understand yourself first and then apply that to the environment we're living in.
Easier said than done, though.
Yeah, oh, for sure. Now, one last thing, and then I'll just pass it over to, well, a couple of things. One is, just briefly, look at corporate earnings. That chart is unbelievable. That is from 2016 until today. Corporate earnings are, people always attribute lots of things to the economy. Oh, the president said this, that the market's going to do this. This cause and effect thing is really driven by probably 20 data points. And one of the most powerful of those 20 is corporate earnings. I mean, when you make money, of course, the economy grows. You reinvest. So you look at that chart, and in 2020, oh my gosh, it went through the floor, and it had a little bit of consolidation. But man, the end of this year, look at that. The last quarter, and that was the second quarter and the third quarter, really. And the thing that's amazing, I mean, you look at the second quarter and you see that huge 25% jump. 25% jump in one quarter.
Yeah.
But the hard thing is to sustain that. After you do 25, it's hard to increase from there. And then in the third quarter, we went up another 17%. That is unbelievable. So even now, we're in that earnings season, and we're still seeing reasonably good earnings, and I'll leave that for Brad to talk about. But then on the overall economy, 5 of the indicators, there's GDP growth, labor market, inflation, consumer sentiment, and housing. And I'll just point out a couple of them. One was GDP growth dropped in the third quarter pretty dramatically. And that was because of the variant that came out and because of the discussion on tapering and inflation. That just pulled things back. Inflation, that's the one that I'm most concerned with right now, because even with, in the middle of last year, it was all, what was the term they used? Transient inflation. It's transient, meaning short term. I don't know who believed that. I mean, you cannot flood the market and think, oh, it's going to be temporary.
Well,
no
isn't all inflation transient? Because
yeah, it just depends on what periods.
Hey, you know what? It's not 7% right now. It's back to 3.
So is transient?
But it's still going up.
2 years, or is transient 3 months?
Yeah, it's the window of measurement always.
Yeah. So anyway, that's one of the points really when we transition to where we are today and what do we do. I mean, those are 2 big factors. Is what is going to be the sentiment of people regarding the fear of healthcare and the pandemic, and then inflation, and how do we address it? Because it's here for a while, in my opinion.
Good points.
Could be.
Really good points. So Brad, on that note, he's laid a backdrop for what happened last year, gave us a couple of good data points. Where are we going? What's happening? Brad, before we dive into that question, I'm sorry, tell us a little bit about yourself. We haven't had you on a podcast for about a year now. Hit it. Who the crap are you?
Well, maybe I haven't been out here in front of you because I spend most of my days back with my team, kind of in the back offices, minding the investment store.
Yep.
I'm a big believer in a behavioral approach to money management. So when I get to work with you two, who are very skilled, you're good skilled people when it comes to helping people understand the key concepts, the core concepts in front of them. My job is to make that whole solution work better and faster. So as I'm looking at things from the investment side, I'm a behaviorist by nature. I love talking about investment forecasts, but at the same time, that's all they are, is forecasts. And we could talk about economic indicators, which I think is important, and we're going to do that right now. But they are simply indicators of what's happening in the market around us. In reality, we live in a world where I think investing itself is a science, but being a successful investor is actually a behavior. And so we try to implement a behavioral response that gives you some ability to bring tools and tactics and specifics to your client's table.
Sure.
So let's flash back to February of 2020. We were looking at these economic and financial indicators, The important thing is not necessarily to drill down into the dynamics of each. But if we were to look at this chart of economic indicators, what we'd see is kind of a bright sunrise. We would see a generally positive economy that's clicking on a lot of cylinders in February of 2020 before the pandemic hit. Things were generally good. There was only 2 areas of the economy that were presenting what were rather specific and relevant concerns at the time, and those were the political environment and geopolitical risk. Pretty common things that do pop up now and again. It's kind of like transient inflation. You're always going to have geopolitical risk someplace.
Yep.
Yeah.
Okay, as we click to the next period of time when we take a snapshot of these indicators, it's November of 2020. Almost, 9-10 months later, 8 or 9 months later than the first snapshot. And you can see a difference in terms of the indicators out there. Instead of just 2 kind of like warm spots of potential risk to the economy as a whole, now we're seeing more indicators be a little bit more middle of the road. There's more problematic indicators. Disposable personal income look like it might be challenged and dropping in late 2020. But let's see this one more time. We now have gone through the initial pandemic, the Omicron and Delta variants, all of the concerns that relate to that. And I think that the pandemic and the COVID-19 virus, what it actually did at the end of the day, aside from creating a huge healthcare crisis in the country, it actually forced a lot of us in the economy, a lot of companies to look at things differently, to do things differently, to create a new way, just as a matter of survival. And I think this chart from December of 2021 of all of the leading economic and financial indicators illustrates by the fact that it's now almost entirely green and positive. That the efforts through a terrible point in time of these big companies, it's showing up in earnings, it's showing in the economy, it's showing in disposable income, it's showing in a lot of things, including the surprisingly great returns of the financial markets over and above the original forecast.
Yeah, to your point, and maybe said just a little bit differently, I think that whole period of 2020, 2021, analysts were saying this has forced 5 years of business evolution in 12 months.
Correct.
And you got used to what has been termed the gig economy, people working from wherever they want to work from, and can we collaborate in that new space? We're a much more, I hate to say evolved, but we are a much more evolved society because of that. We have a lot more fluid and dynamic response to business turmoil and changes in management and personnel, which we need going forward because the problems haven't gone away exactly.
And even those people who would not necessarily agree with your point of view would also agree that the pandemic has forced them to do things in their life a different way. They might not have wanted it, but here we are today, and the fact is the economy is showing the results of that sort of evolution. Now, let's advance. So the key leading economic indicators, the good news and bad news about this particular type of chart that we're looking at here is that it's difficult to gain any sense of what is specifically happening in the current environment without looking at the broad context. So this chart takes us all the way back to roughly 1960. And we can see that over time, our economy has grown. And it's grown in a variety of different ways. Now, we will certainly argue, I'm interested, of the several leading economic indicators, everything from jobs to housing to everything in between. Give me some feedback, guys. Is this a relevant look that helps us make decisions going forward? Or is this more of a snapshot that'll help us better understand the investing world that we're in now?
Let me take a stab at the first part of that, because I think when we look at trend charts like these, we have a tendency to apply all the previous factors. Everything used to be, we're going to apply to the future. And that's not really the case anymore. Case in point, you have the baby boomers, the world's largest generation, right?
Right.
You have Gen X, we're 25% smaller. And then you have the millennials and Gen Z behind, which is bigger than the baby boomers. Take those demographics into impact or as an overlay on top of what's just happened, And you're starting to see a very new set of data points.
Right.
Take Social Security, for example. That's always been a problem of being underfunded. But if you bring on line the largest workforce that humanity's ever seen, well, suddenly Social Security problems are somewhat solved because you have more people contributing into the lockbox.
But at the same time, it's also a generation that appears to have a very different view of what the workplace is all about.
I think every generation said that, though. I mean, I am certain that when they returned from World War II, the baby boomers had a very different outlook on society than their agrarian parents. So that's always the story. It's the adapt and transform.
Yeah, and it goes back to what we were saying before: is the challenges that are presented to us.
Yeah.
It's a test of our resiliency and our adaptability. I mean, and that's a human nature factor. I mean, the reason humans are what they are is because they're good at adapting. Now, in some ways, that's bad too. I mean, as much as we've become a lot better at, the drive of technology and the way business is done now, it also comes at some cost. And there's a lot of lack of human contact that I think is a fundamental need of people. Mm-hmm. And that does play into the economy. I mean, the reality is we've kind of swung all the way from, these mass group things that we love to do to isolation. And now we're saying, okay, what does the future look like? And that plays into a lot of areas of the economy.
Mm-hmm. And I love these types of philosophical conversations, but here's the great news for me. I'm going to leave that to you guys to have those conversations. And I'm going to take us right back to some data so we can talk about what's happening right now and what we're doing about it. So clearly we've got some headwinds and some tailwinds that are facing the financial markets right now. Those headwinds, of course, include all of the obvious things. The COVID-19 and its results, the Omicron and Delta variants. Any new variants that are coming along as we speak and what impact they'll have. Mm-hmm. All those sorts of events and dynamics and information points are going to be critical to the behavior of the markets going forward. If there's a high degree of fear or a low degree of fear, we'll see that evident. John, as you indicated, inflation, interest rates is a relatively good-sized headwind these days as the Fed struggles to balance the speed of the economy, the growth of the economy with the money supply and what that does to interest rates and the cost of borrowing. That's a slippery slope for them to work on, so we'll need to keep an eye on that. Now, the Fed, of course, has had a major pivot in their policy as the economy has grown by all appearances to be so healthy and so profitable. The Fed has to start tapering down their supply, or at least they tell us we now have an opportunity to taper our supplies and raise interest rates as many as 3 or 4 times in the coming year. So we don't know exactly how that's going to impact the markets. We know it sounds bad, we know it looks bad, we know that nobody likes paying a higher interest rate, but we don't know what the end game is going to be. So we're going to keep an eye on that headwind. And then to throw into the mix things like China's zero COVID policy and how that has affected the amount of buying that China does in the global economy, the amount that they can produce for the global economy, and so what their internal policies have done to affect that. Okay, of course, other things like the political landscape, midterm elections, geopolitical tensions, those will always be there, or at least they have consistently. But we never know when an isolated event somewhere, somehow, it could throw a curveball at this market. So that's the things we need to be aware of. That should be part of our dialogue to talk about what if. Mm-hmm. There's also some really great what ifs on the other side of it. We've got some tailwinds that are pushing us farther ahead. Our economy continues to expand. We are enjoying the aftermath of the forced COVID reinvention or the post-pandemic reinvention. As these companies who have had to adapt and create new technologies and had to innovate are now seeing the results of that and some really strong earnings across the board.
See, one thing, and I don't know if I can really directly draw a parallel, but if you look at the 90s and the incredible growth of the 90s and what was, and there were, like I said, there's multiple things that drove that, but one of the big ones was the microchip. The fact that you could automate so much and you could work with computers so much. That was really the era when computers affected business, and you had that long expansion. And so I'm curious to see with the innovation and the pain of change that we've had over the last 3 years, how much of that is going to affect in the same way? We've innovated, and now what's the result? Do we reap the benefits now?
And I think you bring up a really great example. So the microchip is a very powerful evolutionary tool. But ironically, if we step back and take a look at everything, it's one step.
Yeah.
It's a big one, but it's one step. And now we've gone from the point where we acknowledge that there's technologies like chips and everything else that give us greater and greater and faster and cheaper technology, innovation, power. And now we're converting that into almost an experiential world where all these companies are now supporting what is a next big unknown in artificial intelligence.
And it's the reflection, reality. Exactly what you're saying is the reflection of technology got ahead of human ability or human behavior. Mm-hmm. And the last couple of years forced us to try to use that technology that we really were not keeping pace with.
And that's, for guys like me, that point right there is a great thing. We know that we can scientifically look at creating an investment policy. We know that we can custom tailor portfolios to anything that your clients need. What we can't control is the market or the general public's reaction to that. Mm-hmm. And the market will always get ahead of itself in the good times, and it will always get behind itself or overly pessimistic in the dark times. Mm-hmm. And I'll show you what we can do with that. But take a look at this chart on equity values. So what I find is very interesting is in the blue dotted line in the center of our screen gives us an indication of what historically the average price to earnings ratio has been for stocks. Now, instead of jargon or keeping it jargon rich with the PE ratio, a price to earnings ratio is what is the investing public willing to pay for the earnings stream that great companies are generating. And historically, that average has been around 16. What is it? 16.8 times. And it's normal, again, for markets to get a little bit ahead of themselves or a little bit behind themselves. So one standard deviation or a normal range of difference from that main central 16 PE ratio, it's normal to see the price earnings ratio get down as low as 13 or 14 and up as high as 20 or 21. And we've seen a couple of periods of time where the market got way ahead of itself or way behind itself. And going back to the dot-com bubble in 99, 2000, we saw PE ratios up 24, 25, 26 times. Yeah. Mm-hmm. And similarly, we started to approach those numbers again as we came off of the end of the pandemic. So there's speculation. Tell me what you guys think. Are prices on stocks too high right now? Or appropriately valued? Or too low?
I think that what we've seen in the first part of this year is that consolidation is saying, okay, where's the real foundation here? And so you've seen a little bit of a pullback, and it's not purely based on prices, but I think that you've got to always remember that it's not this flat tabletop. It is going to gradually rise, and that's always going to be pushing that PE ratio to some degree.
I think to that point, one of the most broad questions I'm asked is what is the real market right now? Yeah. Anytime you come out of a situation like what we're in, and we've really experienced the growth inside growth stocks, the Googles, the Teslas, the Amazons, and I think there's just been so much froth in the market, and it's really revealed itself in two data points. The first was the week before fourth quarter earnings. You saw an 8% slide in 1 week, and that was a little jarring. We thought, okay, maybe the ride's over, and earnings season started. And earnings season pushed the market up in the end of the year for another 12%. Huge growth return. Well, guess what happens the week before this quarter's earnings report? So right now we're in earnings reporting season, reporting what happened in the fourth quarter, right? Mm-hmm. 18% drop from Thanksgiving until the week that earnings season starts. So somewhere in there's a market foundation. And it's a little hard to discern because we've had so many growth stocks just take off on us. Mm-hmm. Value stocks haven't performed even remotely close to that. Mm-hmm. There might be a pivot occurring. According to a lot of these different headwinds, we might be shifting back to a value proposition, which is going to be heavy in dividends, heavier in interest rate rising, and inflection points. What do you think? You're the guy making the cherries.
I think that attempting to identify and determine if there's some sort of shift in growth versus value, or in a shift from a secular bull market to perhaps a bear market, is a lot like having the conversation on transient inflation. I think there's always a shift from growth to value, value to growth. There's always a shift from large cap to mid cap and back.
But back to the equation of, are we paying too much for positions? As long as we're so tilted toward growth, yes, we absolutely are. And the 90s was a perfect example of growth stocks leading the day. That's why the multiples on price earnings were so high. That's why the multiples on price earnings are so high right now. Because we've been so heavy into growth, and especially tech.
And again, from my behavioral point of view, I don't think the central question is, are we paying too much or are we paying too little? I think the central question is, this is what the market is paying around us. What do we do with it?
Because you can argue that point, even if you look as that backdrop of the 90s, you could have got 3 or 4 years in and said, it's way too high. And then it kept going for 4 more years. So it's hard to say, oh, are we too high? And it really is more a reflection of the relative momentum of the market, and because it could keep going. I mean, the one thing we know is the market has always grown. Now it's had its pullbacks, but the chart doesn't lie. I mean, it goes up. And so the question is, in what way do we adapt that into what we invest in?
And that is effectively the meat and potatoes of the issue, because as I and my team spend all day, every day, maintaining our preparedness to be actionable and fluid with strategy, no matter what the market throws at us, we acknowledge the fact that you two and your clients have got a very difficult conversation, because we're trying to convert this theoretical, these opinions, these forecasts about the economy, these concerns, as well as, it's easier to talk about concerns than it is to talk about opportunities. But the fact is, there are some fantastic opportunities around me. Take a look at this interest rate outlook, at the chart on key interest rates. So specifically, in the context of talking about inflation, interest rates are a direct reflect of that. And when the interest rates in the market start to reflect policy, behavior, attitudes about money supply, I think something absolutely fascinating has occurred within just the past year. What we're looking at here is, this is a chart of the Treasury yield curve. The Treasury yield curve is a fancy way of saying a comparison of short-term to long-term interest rates at a snapshot in time. And the light blue line at the bottom is the line that reflects where the Treasury yield curve was just 1 year ago. And the yellow line that's up above it reflects where those same Treasury interest rates were 1 month ago. And the darker line at the top is where it was just earlier this week. The general conclusion that we look at is, we can see the behavior of how interest rates have done 2 things very importantly. Number one, yes, interest rates have risen over the past year. But the real interesting thing to me is showing how there's been a shift towards the shorter end of the yield curve. For instance, a 5-year Treasury bond 1 year ago, you could have bought it at a yield of about 0.5%. That same 5-year note today, you'd be getting a little bit over 2% on that. Now, it's only a 1.5% rise in the interest rate, but in terms of the degree of change, the relative yield has more than tripled in that same 1 year period of time. So we are right now, I'll tell you this, as far as our outlook, our approach, we're shortening duration on bonds. We think we can let a rise in interest rates be a gift, not a curse. That doesn't mean there won't be some short-term challenges and some short-term financial damage that could occur. But if we can come out on the other side with an actionable game plan to walk up the ladder, to climb the ladder of interest rates as they move higher and higher, yet while we're still focused today on principal safety or on principal stability, I think that's a powerful thing to have in our hip pocket today.
So let's talk tactics about that for a second, because one of the struggles we've had over the last 2 years, maybe longer, we couldn't find bonds. We have a bond portfolio we manage for our clients, specifically municipal bonds, because they're a little safer if the city can't pay, they just reach deeper into the taxpayer's pocket to pay it. So that's about as good as life gets. The inventory of those assets have just been negligible. If anything, it's taken us between 6 weeks and 2 months to find a full allocation.
Yeah.
As we play a shorter duration, gives us opportunity to higher yield bonds, right? Build back, no, that's not what it is. It's the infrastructure bill. The infrastructure bill, lots of bridges, lots of stadiums, lots of roads, means lots of municipalities going out for bonds. Interest rates increasing.
Yeah.
Finally, our fixed income portfolios will start performing better. That's great news for most of our people because especially those in retirement, in that new chapter where you're not accumulating, you're preserving that asset, those tools of municipal bonds are key to keeping them safe and not wading deeper into the interest rate pool. So what do you think about that?
I think that you have just hit upon a very key point that could potentially impact the performance of every single investor we work with. Let me give you an example. I think that we're really not talking about the supply of bonds being the limit. I think what we're really talking about is discipline and patience. Mm-hmm. So what I mean by that is, when I was growing up, my dad always taught me, if you don't know what you're looking for, you're never going to find it. And I think that's good life advice in one thing. And as we apply that same sort of life advice to the bond market, we need to be aware of two things. Number one is that while the stock market is screaming around us and screaming earnings and screaming updates and news and information, the bond market whispers. There are relevant things happening in the bond market, and the fact is, you're right, we can't just go out and pull the right bond portfolio off the shelf. Anything that is attractive and desirable is often scarce. Mm-hmm. Doesn't mean it's not out there, it just means it's scarce. So it's our job as a team to be patient, to be disciplined, and to identify exactly what it is that we're looking for. Yes, it might take 3 months, 6 months. It might take a year or two to build an ideal bond portfolio, but that's what we're building. We're not building an immediate bond portfolio, we're building the ideal tool to navigate us through this time. That's where I come from, and that's frankly where the three of us should butt heads on. Of course your clients want to see their money deployed effectively. Of course you want to provide that as advisors, and my job is to push back a little bit and say, well, if we're going to do it right, here's what it's going to take to do that. And we find something that works for the cumulative team. Mm-hmm. Okay, let's shift gears over to our projections on what happens in the market ahead. Like everybody else, I also forecast returns, but I don't do it through economic indicators and anything else. When I look at market projections, I'm using technical data, the data that compares buying and selling activity, that gives us an idea of how far the market could go and what sort of problems the market could run into. Mm-hmm. So as far as our projections here at Wealth Advocates, last year the S&P 500 closed at 4766. If I had to bet you a box of donuts, I would tell you that at the end of this year, we're going to see the S&P 500 close out 2022 at around 5,430.
Which is significant. That is 1,000 points above where we're at as of this recording right now. Right. We've had a massive pullback, and so it feels like there's some advice in there, right? You think it's going to go up 13, 14%? Above where we ended the year. We're down 18%. John, what's the attitude?
Yeah,
what should happen?
Well, and the attitude is people are sitting on their hands saying, I don't know. And in any market, when you want to buy is when everybody is crying and there's blood in the streets. You want to be looking. And it's hard. That is easily said and hard to do. It is hard to behave that way. And again, it still goes back to what I said. Don't go outside your comfort zone. We're not saying go crazy on risk. I'm saying, when the opportunities come, we need to be able to take advantage of it and realize there's going to be a sentiment of, this does not feel good. Because we do the opposite. When everybody's talking about, end of last year, Tesla and all the others, it's too late. They've already run. They're up here now. So we've got to be real about saying we need to be shifting to where the opportunities are. And a lot of times, they're the ones that are out of favor.
You notice I got kind of silent there when he made that comment because I'm not sure if I fully agree with some of that.
And that's okay.
I think that there is a case to be made that some of the most successful companies have got a habit of success and will find a way to continue to be successful and continue to innovate and continue to bring new products and new ideas that'll continue to push that apparently high PE ratio even higher.
Yeah.
Now, that's me talking as a person. I'm just telling you what I think the data suggests. The data and the behavior suggest we could see a 13% increase over the next year and see an S&P 500 up around 5,400.
And I don't disagree with that. All I'm saying is right now, with the pullback, now's the time to be looking.
So let's then look at it through these lenses. What if we're right and what if we're wrong?
Yeah.
Okay. So as far as our suggestions moving forward, if these are the technicals that we're seeing in the market, if these are the possibilities, despite the fact that what any of us might be fearing is going to happen on the day-to-day, if those are the possibilities, I think we should lean cautiously into this market. Doesn't mean that we sell all our bonds and buy all our stocks, but I think it's time to identify some value and lean a little bit into the market. I think that along with leaning, that we need a process through which our investing clients can revisit the strategies with you and just take the market temperature on it periodically and get some feedback and some guidance from you on a global strategy, on their global objectives, and then on our end, we're going to suggest that they bifurcate purposefully. What on earth
Such
is
a good
that?
line.
So, meaning, this is a purpose-driven behavioral response to investing. If you two can, with your clients, help determine exactly what each investing account for your clients is determined to do, what the purpose of it is for that client's best benefit, then we can help tailor the strategy that is most likely to deliver the type of behavior that's expected. We can't guarantee that the market's going to go up. You never know what you're going to get. But if we have an idea of what we're looking for an outcome for a portfolio, then that's going to give us much better odds of actually putting together a portfolio that balances and works together towards that client's best outcome. Now, look at the history of the markets over the last 3 years. You know, the headline that I use for this slide is "Fortune favors the properly prepared," and it's very, very true. Without an expectation that markets are going to go through big periods of updraft without apparent explanation, markets are going to go through periods of correction without apparent information at the moment, we're going to see aberrant behavior to the upside and the downside. The question is, what do we do with it? But look at this chart over the last 3 years, and if we take a step back, we can see that over the past 3 years, the market's gone up about 73%. And that's unusually good. But if we also look, the numbers that you see on your pages below the candlestick type of graph that we have here indicate the degree of short-term periodic pullbacks and corrections. So if we know, but we don't know when, if we know the market's going to give us some sort of correction and we're prepared today, we have a plan in place to take advantage of it and to fluidly navigate right through the middle of it, certainly that would be a benefit, but that's got some pitfalls. What do you two face on a regular basis about?
Well, I think the construct of our portfolios reflects that. In all of our portfolios, we have an equity mix, we have a fixed income mix, and we have a cash mix. And people will look at that and say, why are you holding cash right now? The market's at the high and I want more. And it's the constraint and the discipline of investing where you've got cash. It's a war chest for strategic purchases. You've got cash derivatives like short-term treasuries and other bonds that we can pull from. We like to pill off cash at the high. And I know academically that sounds like the right thing to do. But I'll tell you that when you're sitting in September of 2021 and it doesn't look like the party's ever going to end, that's a really hard thing to do.
It is.
I've had some clients hit me on the hand that, hey, what are you doing pulling that stock out? I like that.
Yeah.
Well, it was great the next month because I had something to buy with.
Well, and you can take it to the extreme, and you've seen people say, it's so high, take me out.
Sure.
Get me out, it's going to fall. Or the first initial drop is usually where you see that.
Yeah.
Get me out, it's on its way, it's going to drop. And that may well be true, but you're still working on guesswork. You're working on instinct instead of working on probability and success, which means, statistics, which means to me, are you going to try to guess around the market, or are you going to use statistics and data to work through it? Which has the highest probability of success? And I know which one it is. I've watched it over and over for my whole career.
But in the moment, it never.
It is hard. It is hard for any person to say, we're just going to go forward with the strategy when they can feel the ups and the downs.
Well, and the fact is that becomes a good 1-2 punch that the different sides of our business have. On one hand, you can talk about the emotional aspect of the markets and what's happening. And then on the flip side of that coin, we can be looking at the data, the analytics, and the behavior of the markets and helping to make small, gradual, corrective sorts of changes, enhancements, whether it's pulling cash off the table or whether it's forcing a buy-in at some of the lower prices. Both are positive things. Mm-hmm. But I think that the big thing is it's easy to sit around and talk about the market. We think the market's going to go up, go down, or go this way or go that way. And the fact is, our clients are not the market. The people are different from the market, so we have to separate those two things. Okay, so the things we can do to set our table properly, where fortune does favor the properly prepared, those 3 areas. Number 1, we don't know when market corrections are coming, but we know they're coming. Someday, somehow, some way, we're going to see another correction. So let's make sure there's a systematic plan in place today so that we're able to take advantage of it then. Let's mind the emotional swings. Let's separate the market from the personal response. The markets can go up and down, but our investing clients deserve good counsel and advice during stressful, economic, anxiety-ridden times. And then we plan for those future opportunities so we can determine if there's a correction or an event or a windfall in the markets of this percent that is unusual by historical standards. We can pin down some specific metrics about exactly what we should be doing about that and how do we get that in place to plan for that opportunity today. All right, that's where I stop. I'm happy to bring some more information to the table, but we gotta just
all right. Let's talk about next year. Let's talk about where we're going. You took us where we came. You took us through the present. Let me be the soothsayer and walk you through the future here. That's really where I specialize, is in the fiction of the future. But I am cautiously optimistic. I like hearing there's a 13% upside. But man, we've got a ton of problems. And so I think the best piece of advice that you gave us is just to be cautious about it, to be prepared about it. And that requires that we move away from the fiction and we deal with the facts. My favorite angry podcaster, Ben Shapiro, always says, the facts don't care about your feelings.
It's true.
And there's no board game that's more applicable to that than the stock market. So let's talk about the facts and let's kind of work through those. The first one I want to talk about is what the heck is going on in household incomes and in business incomes. You have seen, there's going to be a chart up here, and you're going to see the assets of all the corporations out there and the trillions of dollars going up. That's great. You're going to see a red line on here that represents consumer debt. It stayed exactly the same. Why? Because we've been giving people money. We've been printing money. During a pandemic when no one went to work, you would think that debt would skyrocket because that's how we're surviving. But because we were giving you checks during that period of time, your debt level remained the same. In fact, your net worth increased. Your consumer tendencies increased because you had more cash in your pocket. Mm-hmm. So assets, liabilities, net worth, that's a pretty important thing. Net worth of most Americans has gone up in the last few years. You talked early on about corporations and their corporate profit and earnings. So let's turn back to that. In 2021, we ended 2021 with most corporate earnings up 39.8%. Wow. And most, I have this backwards. The revenue was up 17%, but the earnings, the profit was up 39%. That's tremendous. Mm-hmm. How does that occur? Well, if you have this window of opportunity where inflation hits, but your cost margin doesn't. I can sell a good on the I can sell a good that was on the shelf for a lot more because of inflation. The next round that I bring in, it's going to cost me more. So we have that window of opportunity of greater profitability. That might be diminishing in the near future. That's going to impact corporations. That's going to impact stock market. This morning, Market Watch, we're going to talk about inflation now. This morning, Market Watch said that retail products were 7.5% more expensive than they were last year this time. What does that mean, guys? What are you going to do?
Yeah.
If things cost more money, yes, we gave people a lot of money, but now you don't have enough money. So people's savings rates are going down, the cost of products are going up. That's concerning to me. Mm-hmm. Consumer spending ability is not what it used to be. And so that may change the tide of things. The reason why that's so important, this is such an interesting fact. 70% of the US GDP comes from US consumers. We reflect 5% of the world's population. And yet we are sustainable internally to the degree of 70%. We only export 30% of what we make. Most of what we make has shifted from producing steel and car and bridges and trains to making software and DocuSigns and services and YouTube videos.
Yeah, that's surprising.
I
would think those numbers would be quite a bit different than what you just said.
Yeah.
Interesting.
So as our economy shifts, and it has shifted, we talked earlier about the evolution of business and how that takes a role in it. The U.S. economy has shifted quite nicely in the face of COVID. People can work from wherever. We can collaborate anywhere in the world. 2 of my employees do not live in Logan, Utah. One lives in Florida, one lives in Texas. Mm-hmm. And we still collaborate just fine. Mm-hmm. So that whole mindset shift of we don't all have to be in the same office, that we actually don't manufacture steel and other goods. We manufacture services and other supplies that don't have a supply chain. That makes our economy a little bit more robust. So that's a plus for us. Another plus for us is, I'm going to announce this right here on TV, so this would be where we want to zoom in. COVID is over. I don't know. Is it over? It seems like we're relaxing a lot of the mandates. Even New York is relaxing the mandates. When we get to that point, things are looking up. Maybe the petrifying fear will start to dissipate. Maybe people will return back to work. That's the key. When 70% of your GDP comes from U.S. consumers, you have to have those U.S. consumers with cash in their pocket and ability to sell. If they're not healthy, we don't have either of those things. Right. That's where Peloton and Netflix does really well. Mm-hmm. Peloton and Netflix are not doing well right now. Right. Because people are getting healthy, they're going back out, they're spending their money. So the end of COVID would be a big boon for this economy and support that 13% upside.
It would.
We hope that this inflation is transitory. And here's a reason why it would be. Most of that supply chain is on the docks, 99% finished. Ford even announced they're going to start shipping the trucks to the dealerships without chips. So that's close. We can't drive it yet, but it's in your city. Mm-hmm. And the service center will put the last bit in. That might suggest that there's a tidal wave of supply chain coming in. We may have that hit all at once. And what happens when you have too many goods, too many supplies on the shelf? What does that do to inflation?
Yeah, it's going to temper it.
You have to go the other way.
The other thing I think this is significant with what you're saying is if people are not fearful to go back to work. Now, granted, you have some jobs that you're working in, remote locations. Some jobs are not that way. And look at the demand. I mean, we're having so many challenges getting people to come to work in certain industries. Well, what happens if that fear dissipates? Will that allow people to fill those jobs more readily? Because right now, payrolls are dramatically going up.
Yes.
Because you're paying more to try to get people to come in because you're dying. You got to get this, keep the doors open. I mean, there was just a little fast food place shut down because no one came to work. Yep. I mean, that's happening frequently.
I'm sorry to interrupt, but I think that might be part of a real secular shift. I think the workplace, I think the workforce is viewing the workplace in a very different way.
Oh, for sure.
Not just because they've had to, but because they could. And I'm even going to take one step back at supply chain. My personal feeling is I believe that supply chain, which has been a debilitating problem, is the metaphorical COVID of the economy. So in the same way that we had a pandemic affect our people and cause us to stop, shut down, and dramatically rethink how we're going to
it is COVID. It was You
It's
guys got to
exactly
stay
that.
home, so you can't make anything. You can't make anything, so there's nothing on the shelf. There's nothing on the shelf. So what is on the shelf costs more. It is all related to COVID, and COVID ending, which we hope might bring a resurgence. But John brings up an excellent point with unemployment. Unemployment's a huge issue. Employment numbers, the cost to employ somebody specifically, has gone through the roof, like you articulated. Do those numbers come back? Do we pay our people less?
Yeah,
Well,
that's
you've
hard
got
to
to
put
fire them
the,
and hire a new person.
tough to put
Some
the
of those
toothpaste
jobs
back in
are
the tube.
gone. Yeah, we're not going to have that. You know, in the 50s and 60s, you had a person that operated the elevator. That job's gone.
Yeah.
Well, we might experience that same thing
Yeah.
in different.
Oh, there's no question that will be the
I mean,
case.
is a fast food restaurant really going to become a on-site vending machine? I don't know, but some of these jobs are changing. Those
Yeah.
people aren't going to go back to those jobs, and new jobs are being created. So there is a continued shift in the economy from an investment standpoint, from a retirement standpoint. All those things come into play as to where our portfolios go and how we get there and how we structure them. I think I'm going to just jump to, you covered you covered the projections really well. We hope to see a 13% upside, but there's so many things out there.
Yeah, you never know.
Inflation, COVID, unemployment, getting people to return to work, high cost of employment, and supply chain. Those could all torpedo our forecast. In any given order, if you have a war and Russia invades Ukraine and China invades Taiwan, that's going to shift a whole bunch of things.
And that's true. You never know what you're going to
Yeah.
get. So I think that the timeliness is now to talk about what do we do if?
It's
what do
discipline.
we do with it
Yeah,
when?
perfect. It is discipline. If you look at the stock market in a 1-year period, if you have a day trader mentality, your portfolio can shift from 48% on the upside to 39% on the downside. Even the bond portfolios aren't really supposed to move. The asset value does move, and people don't understand that. But you can have a negative 8% return in a bond portfolio, or you can have a positive 43% if you buy right in 1 year. If that window of measurement is really, really small, your volatility is astronomical. And so the push for all of us, and one of the action items for our clients this year, is to take a good hard look about what our longer term plan is. Let's look at like 5 years down the road. That's not too long. Even 10 years isn't that long. But a 5-year rolling average, if we look at, we bought a position, we got a great deal on it. Maybe there was a better deal in the 30 days afterward, but it's a good product. It's going to be a good stock for us going forward. That one stock, instead of having a downside of 39 and an upside of 48%, over a 5-year period, that shifts to a 3% downside and a 28% upside. That's a worthy risk.
Right.
If we look at it on a 10-year period, a 1% downside, a 20% upside. Man, those are good odds. We like those kind of numbers. The big push needs to be disciplined. Stay the course. Understand the risk, but stay the course. The guy that gets in and out and in and out and in and out is the one that gets burned all the time. I've never in 15 years figured out how to time the market or read minds.
And nor have I seen anyone else do it.
No,
They all claim they do.
Yeah.
But the reality is, how many have been around for one business cycle? One down, one up.
Right.
Or two. None. I can't think of one.
And let's look at it this way. You know, telling an investor to stay disciplined is like telling anybody else to eat healthy. It's like, it sounds great. It sounds great.
Put the beat up.
It makes perfect sense.
Yeah.
But it becomes a very difficult thing to actually do
To maintain.
on a sustained
Yeah.
timetable. Okay, so there are ways, and we can talk about those another time, but there are specific ways to break down the general good advice of stay disciplined and convert it into a systematic, maintainable, monitorable behavior.
Here's the takeaways, the whole thing. This quarter, the theme for all of our client reviews is market review. We'll talk about where your portfolio went, where it's at right now, where we think these individual holdings will go over the next year. There's going to be a big discussion about, are we in the right lane? Can we stay here for a while? So with all of our clients, we're going to send out a risk questionnaire. Let's relook at risk tolerances. Are you comfortable with your risk tolerances? And let's do some planning for the entire year. What things are going to change? Are there medical issues that we should be aware of? Are there debt issues we should be aware of? Are there changes in your estate plan, your tax plan? Really, it comes back to managing your portfolio as part of a coordinated estate. It has to be your investment plan, matches your tax plan, it matches your estate plan, your risk plan, and your income plan. All those things work together. That is what success looks like from financial planning. It's not just how did the market do today. You might be that guy that writes down your account balance in the morning and then writes it down at night and then writes it down again in the morning, and it didn't really change that much during the night, but still, you do it. It's going to make you neurotic. If you take a longer approach to it, that stock that had a 39% downside and a 48% upside eventually becomes, it has a 1% downside.